The new inflation data is out, and while everybody thought that inflation would have cooled down by now, it looks like it's actually getting worse. CNBC reported that the inflation has hit a brand new record high, and now the Federal Reserve Bank is saying that this inflation will probably last longer than what they expected. And you even have some Federal Reserve Bank officials coming out saying that this inflation is no longer going to be transitory. So if you want to know what's really going on with inflation, make sure you watch this video until the end. What's up everybody, I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. We went from hearing that this inflation is transitory and it will all go away very soon. And then we heard that this inflation is still transitory, but it might last a little bit longer than we expect. And now we're hearing that the inflation that we're seeing is breaking brand new record highs, and you even have some Federal Reserve Bank officials coming out saying, sorry, we don't think that this inflation is transitory anymore. We think that the inflation that we're seeing is permanent, and we think that it's actually going to get worse in 2022. History might not exactly repeat itself, but it does rhyme. If you remember, before the 2008 crash, Ben Bernanke, who was then the chairman of the Federal Reserve Bank, kept coming out saying that the housing market crisis isn't that bad, and he even said that the whole subprime mortgage crisis will not spill over into the rest of the economy, and he said that the mortgage market crisis was contained, and he said that the economy would not see a major crash. And then we all saw what happened after the whole thing imploded. Let me just read you the first sentence of the CNBC article, that way you can get an idea of what's going on, because this one sentence will really summarize everything going on with inflation. The first sentence says, the annual inflation rose at its fastest pace in more than 30 years during September 2021, despite a decline in personal income. So the Commerce Department did a whole bunch of research and they did a whole bunch of data analysis, and they concluded that we are seeing personal income go down while the price of things are growing at the fastest rate that we've seen in decades. So if you went shopping recently and you feel like things are more expensive now, this explains why. Now, thankfully, the Federal Reserve Bank is starting to realize that this might be a problem. But the issue is, their solution to the problem is they want to fix the problem by creating more inflation. You can't make this stuff up. So let's dive into it. But before I do that, I need you to do me a quick favor and smash that thumbs up button below. And if you haven't already, be sure to join our brand new free Discord server called the Guac Talk community. We call it Guac Talk because, as we all know, extra guac is truly a symbol of extra wealth. And in this community, you can chat about all things minority mindset. You can talk about the stock market, the real estate market, the cryptocurrency market, and all things building wealth. This community is completely free, so if you want to chat with and network with other minority mindset thinkers, I'll put the link to how you can join our Discord server in the description below. So here's what's going on. We have an economy that's already slow, and then on top of that, we have inflation that's surging to some of the highest levels that we've seen in decades, and now it's harder for people to go out and afford things because everything is so expensive. And now the Federal Reserve Bank and the government have each proposed a solution to this raging inflation problem. First, the Fed says that we need to keep interest rates low. The New York Times published an article talking about this, where Jerome Powell has come out and said that inflation is becoming a real issue, and because inflation is such a big issue, we cannot raise interest rates. We need to leave interest rates low. This is an interesting solution because low interest rates cause more inflation, but we'll get more on that in just a little bit. And the government also has their own solution. So the Treasury Secretary, Janet Yellen, went out in a recent interview and she said that inflation is not that bad. She says that we have a good grasp on inflation and it's not out of control, and that we have a good handle on inflation. Then she came out and said that although inflation is high, we still got a grasp on it, but we do have a solution for this inflation. And that solution, according to Treasury Secretary Janet Yellen, is to increase government spending. What she says is that the government needs to pass 2 new spending bills, which add up to just under $3 trillion. And if the government spends this $3 trillion, that will lower inflation. Again, a very interesting proposal, because the big reason why we're seeing all the inflation that we're seeing now is because the government has been spending money they don't have, and when they have to print the money to cover these extra costs, that causes inflation. But Treasury Secretary Janet Yellen says if we increase spending more, she wants to pass a $1 trillion infrastructure package and a $1.8 trillion climate and social package. And she says that if we spend this additional $2.8 trillion, this will bring inflation down. So let's dive into both of these, because both of these two things in general would cause more inflation, but the Fed and the government think that they're going to actually bring inflation down. Let me start by talking about interest rates. I'll talk about what this does, and then I'll talk about what the Fed's goal is. So when interest rates are lower, people and businesses are more likely to go out and borrow money because now mortgage rates are lower and credit card rates are lower, so people are more likely to go out and borrow money from the bank. It's the same with corporations. If you can go out and borrow money at 3% or 4%, and then you can invest this new money back into your business and you can grow your company by 6% a year, well, now it'll be profitable for you to go out and borrow money. Or what you're also seeing happen is you're seeing a lot of corporations go out and borrow money at 3% or 4%, and then they're using all of their extra dollars to buy back their own stock, which boosts their stock price. And if they can boost their stock price by more than 3 or 4%, well, now they're profitable. The reason why these type of lower interest rates create more inflation is because when you go to the bank and you borrow $100,000, well, the bank has to get this money from somewhere. And a lot of times what they'll do is they will borrow this money from the Federal Reserve Bank and then they will lend it out to you. So this money has to be created essentially out of thin air, and it gets lent out because the way that the banking system works is it is a fractional reserve lending system, which means if you go and deposit $10,000 into your bank account, the bank is not just going to sit on those $10,000. They're going to take the $10,000, put a little bit of money and put it aside, and they're going to lend out the other $9,000. Then somebody else is going to borrow that $9,000 and they're going to deposit it into their bank account. Then the other bank is going to take that $9,000, put a little bit aside into their vault, and they're going to lend out the other $8,100. And this goes on and on and on. So the initial $10,000 of money that you deposited now gets multiplied again and again and again because of the banking system, because you deposited one time, and now the bank is going to lend it out again and again and again. And if the bank doesn't have enough cash to lend out, they don't want to be out of business. So what do? They go to the Federal Reserve Bank, they borrow more money from the Federal Reserve Bank, the Fed creates this money out of thin air, they give it to the bank, and then the bank gives this money to you. So when interest rates are low, you are seeing more dollars enter our economic system or economic circulation because people are able to go out and borrow money. They're more likely to go out and borrow money, and you're seeing the same thing happen with businesses and corporations. So more businesses, more people go out and borrow money, more money gets created, more dollars enter our economic circulation, and this creates more inflation. And so inflation is when the supply of dollars go up, causing the value of each dollar to go down. That's why a dollar today is not as valuable as a dollar was 20 years ago or a dollar was 50 years ago. A dollar 50 years ago had way more buying power than it did today because of inflation. We have seen way more money printing happen over the last 50 years, causing the value of each individual dollar to go down. And so now, if you save $10,000 in the bank, that $10,000 that you put in the bank today is not going to grow because we are in a low interest rate environment, which means you can get a mortgage at a low rate, but that also means that your bank is not going to pay you any interest. If you put your $10,000 in the bank, you're going to see your $10,000 stay $10,000 for years. And so you put $10,000 in the bank today, in 10 years, your $10,000 is going to grow to $10,000 and a few pennies, maybe a few other dollars. So now you have essentially $10,000 in the bank, but the cost of things are not going to stay the same in 10 years. The price of everything around you is going to be way more expensive, but that $10,000 cannot stretch as far. That's what inflation is. And the reason why you see that happen is when you increase the money supply. When you increase the dollar supply, the value of each individual dollar goes down. And so when you have low interest rates, more dollars enter our economic circulation, which causes more inflation. So at this point, you might be wondering, why the heck does the Federal Reserve Bank want to keep interest rates low to help fight inflation? Great question. Well, it's because we are in an economic environment where our economy is not growing fast enough and our economy is so reliant on these low interest rates. So if the Fed starts to increase interest rates, which would slow down inflation, they're worried that this will slow down the economy, which is not good for the stock market, which is not good for the economy. See, this is where things start to become really dicey and really tricky because we're supposed to be in a free market. And in a free market, you see booms and busts. That's part of the economic cycle, and those busts are where the economic system refreshes. It's where the bad assets and the bad money leaves, and then new money can come in, and that can refresh the economic system. But the Federal Reserve Bank has been trying to almost desensitize us from risk. Like when we saw the 2020 crash happen, we were in the worst recession since the Great Depression, but our stock market crash only lasted 2 months. Why? Because the Federal Reserve Bank opened up the money printer and we saw a flood of money enter our economy. We saw a flood of money enter the markets, and this propped up the stock market. And now what was the most drastic and most dramatic stock market crash in history became one of the fastest stock market booms in history. The Fed does not want to see the economy slow down. That's why they're so scared to raise interest rates, and the price that people pay for that is through inflation. Now, inflation is known as a hidden tax because the person who pays the price for inflation is the person who doesn't understand what inflation is. That's why it's known as a hidden tax. It's a tax on the average person because now when the average person living off of a fixed salary, you have a set paycheck that you're getting every 2 weeks. You take this paycheck and you go shopping, you go buy your groceries. now your paycheck doesn't stretch as far. So the person who pays the price for all of this low interest rates is the average person who doesn't understand what's going on, while the financially educated, wealthy get rich off of this because now all the money keeps flowing back to the top. Because when you're in a high inflationary environment, asset prices go up, and who owns assets? Well, the rich and the wealthy. So the rich now get wealthier, while the poor and the middle class are getting poorer and poorer because now their dollars don't stretch as far. The last time we saw an economic environment like this was back in the 1970s. It was an era of stagflation, which meant we saw slowing economic growth with rising inflation, kind of like what we're seeing now. Now, the government and the Federal Reserve Bank keep saying that we are not in a stagflationary environment right now. I'll explain why in just a second, but they keep saying that we are not in stagflation right now. We're not seeing what we saw happen in the 1970s, but in the 1970s, we saw massive amounts of inflation. Part of the reason for that was because in 1971, the United States took the dollar off of the gold standard, so the United States government was able to work with the Fed to print an unlimited amount of money. So we saw very high amounts of inflation in the 1970s while the economy was not growing and while wages were not growing. So now the question is, how did they solve that problem in the 1970s? Well, it was by raising interest rates in the 1980s. Inflation was getting so out of control in the 1970s because of all the government spending and because of all the money printing and because of all the dollars entering our economy from lending. The government and the Fed had to work to now really try to cool it down in the 1980s. And the way they did that was by ramping up interest rates. In the 1980s, if you wanted to go out and buy a home, you could be paying up to 18.5% a year on your mortgage. 18.5% a year. The reason why interest rates had to go up so much was because that was the only way that the government and the Fed could slow down the inflation that we were seeing. Now, the inflation levels that we're seeing today is not too far off from what we saw back in the 1970s, and the worry is that inflation gets out of control again in this decade, that we're going to have to ramp up interest rates to crazy levels like we saw happen back in the 1980s to cool down inflation again. But the government and the Fed say that we are in a very different environment. We are not in a stagflationary environment like we were in the 1970s. According to the government and according to the Federal Reserve Bank, the reason why inflation is not something we have to worry about right now is because of the cause of inflation. According to them, the reason why we're seeing so much inflation is not because we have a lot of dollars entering our economic circulation. The reason why we're seeing so much inflation is because of the supply chain bottlenecks in our economy. Because it's so hard to get supplies and products into the ports from California, because it's so hard to get products from overseas into the United States, it is very hard for companies to be able to sell their products. And because of that, companies are having to raise the price of the products. The reason, according to the government and the Fed, the reason why we're seeing such high inflation right now has nothing to do with all the excess dollars, but has everything to do with the supply chain issues. Now, I don't disagree. I think we have a lot of supply chain issues, which is leading to the price of some things going up. But what's happening is you have the government and the Fed completely ignoring this side of inflation because they're saying that the only reason why we're seeing inflation is because of supply chain issues, and these supply chain issues are just completely like blocking the idea that money printing could cause more inflation. So the supply chain issues are right now overpowering the idea that money printing could cause more inflation because it's creating a smokescreen. Right now, all they're saying is a supply chain issue because all this money printing is inflation that's behind the smokescreen, which they can't see right now. The worry is what happens if all these supply chain issues go away, but we still have this high inflation. Then what? Now, if you want my personal opinion, now I know I'm just a random guy on YouTube, I do think that these supply chain issues are causing massive pressure on prices of products. And so when these supply chain issues go away, I do think that we're going to see the prices of things go down, because I think that we're going to see a lot of companies over-order their products, which is going to cause an excess supply, maybe even a glut in products, which will cause the price of things to go down. But that's when we're going to start to feel the effects of all this money printing, because you cannot ignore the idea that money printing causes inflation. I mean, that is what causes inflation. When you dilute the value of the dollar, that's what causes the value of the dollar to go down, which causes the price of things to go up. So I think we're going to see a lot of fluctuation in the prices of things, but I don't think we're out of the clear with all this money printing, because we have printed an historic amount of money in 2020 and 2021. We printed so much money even when people were not working. So we're printing this money essentially out of thin air based off of what? Because money is supposed to be some sort of representation or store of value. And if our country and people were not producing, but we're still able to produce money, what happens? The value of our dollar has to go down. So yeah, I think that the supply chain issues are going to affect the prices of products. When the supply chain issues go away, I do think that we're going to see the prices of things go down. But that's when we're going to really start to see what's going on with inflation. And over the next 2 to 3 years, that's when we'll really see how bad this inflation is. So this is the Fed's solution to higher inflation. Now let's move on to the government, because the Federal Reserve Bank, although it's called the Federal Reserve Bank, is actually not a federal entity. They are their own entity. And if you don't believe me, just go onto the Federal Reserve Bank's website. They will say clearly on their website that the Fed is not a federal entity. But now let's move on to the government, because here we have the Treasury Secretary, Janet Yellen, saying that inflation is an issue, but not that bad of an issue. And the way that we can fix this issue is by increasing government spending. Let me just read you what she said so you know exactly where she's coming from. So this is from the CNBC article that I was showing you a little bit earlier, and she said, quote, "The extra spending, the $2.8 trillion, will boost the economy's potential to grow, the economy's supply potential, which tends to push inflation down, not up, because for many Americans who've been experiencing inflation, like with gas prices going up, this package will lower some of the most important costs because they will pay for healthcare and they'll pay for childcare." So what she's saying is the government should pass 2 new spending bills, one for $1 trillion to help with the United States infrastructure, and the other is for about $1.8 trillion, which would aid to pay for things like preschool and childcare and maybe even daycare. So let's break this down. The government is not a for-profit entity. They get their money to pay for their spending through people like you and me, taxpayers, through tax dollars. The harder you work, the more you pay in taxes. So when the government wants to spend money that they don't have, they have to do one of two things. Either they're going to have to raise taxes, or they're going to have to borrow this money from somewhere else, because everything has a cost. And we're already seeing the government talking about raising taxes as a way to cover some of their new spending bills and to help cover some of their spending from 2020 and 2021. But what happens if they cannot raise enough money from taxes? Which we already know the government doesn't have a pile of cash sitting somewhere, because if they did, we wouldn't be facing this national debt crisis, because right now the United States has something like $29 trillion worth of national debt. What that means is the government has spent $29 trillion that they don't have, and now they have to pay this money back plus interest. So what happens if the government cannot get this money through taxes? Maybe their tax dollars don't cover it, or maybe they cannot raise taxes enough to cover their costs, because the government will never be able to pay for all their spending by just raising taxes, even if they skyrocket taxes, because spending always increases. They never slow down their spending. Well, this is where the government is now forced to borrow their money from somewhere else, like the Federal Reserve Bank. Now, the interesting thing about the Federal Reserve Bank is they're not sitting on cash reserves either. They have the ability to print this money out of thin air. So the government wants to spend money that they don't have, whether it's for these spending bills or whatever it is. The government wants to spend money that they don't have, so they go to the Fed, they tell the Fed that they want to borrow money. The Fed prints money, they give it to the United States, and now the United States has trillions of more dollars that they can spend. They borrow this money, so they have to pay it back. The national debt goes up, but the United States can now spend this money in the form of stimulus, in the form of whatever they want, and now the government has cash they can spend, and now this money gets injected into our economy, but somebody has to pay the price for this money printing, because this cost has to be eaten up by somebody. Nothing is free, right? Well, that cost is paid for by the average person through inflation. Because now if the government borrows money, this money gets created and enters our economic circulation, what's happening? We're increasing the dollar supply, which means the value of each dollar is going down. So who's paying that price? Well, the average person through inflation, because now you're seeing more inflation. And so now when you go to the grocery store, it's going to cost you more money. Why? Because the value of your dollar went down. So the person who pays the price is the unfinancially educated, because now it is a hidden tax. Inflation is a hidden tax that the average person, the person who is not financially educated, has to pay. When the government raises taxes, you know who's exactly paying for the government spending. If they raise taxes on the rich, well then you know the rich are paying. If they raise taxes on the middle class, you know the middle class is paying that price. But when they don't have enough money coming in through tax dollars and they're forced to borrow this money gets created out of thin air. The government spends this money, which might seem great in the short term because now there's a brand new influx of cash, but then the price of this new spending is paid for by the average person who was not financially educated, because now you have to pay a higher price for your cost of living while your salary is not growing with inflation. Now, based off of that, you might be thinking, how in the world is increased spending going to help solve the inflation problem? Good question. So this is where the Treasury Secretary says that this increased spending will help solve inflation because it will do two things: increase infrastructure and lower some of your costs. The increased infrastructure is supposed to make transporting things from one place in the world to another place in the world, or I guess in this case, one place in the United States to another place in the United States, cheaper, because you're supposed to have better infrastructure. And then the other plan, the social plan, is supposed to make some of your costs easier as a citizen of the United States, because now they will help pay for your childcare, they'll help pay for your daycare, and they'll help pay for things like your preschool. So what she's saying is they want to increase spending right now, which would increase inflation inflation right now, but the goal is to decrease inflation over the long term because they will lower the cost of things. And if she's right, we understand what that would do. That would lower inflation. But let's talk about what happens if she's wrong. For one, what we've seen happen time and time again through history is anytime the government says that a proposal is going to cost X amount of dollars, whether it's $1 billion or $1 trillion, because nowadays $1 trillion doesn't seem like a lot of money, it always ends up costing more than that. It always ends up costing a multiple of that because for whatever reason, they're not able to figure out what the cost of the proposals are before they actually pass it. Second, the government says that they want to take care of your costs. So they want to mitigate some of the burden that you have by lowering your costs. Now, in theory, that makes sense because now if you have less expenses, now inflation isn't as bad because you can pay the higher prices for groceries because you have less costs. But again, somebody has to pay the price of that. It's not like your daycare or your preschool teachers are going to work for free. They still want to get paid. Now, what they're saying is the government is going to pay for them for you. So the question is, now where is the government going to get this money? Either they're going to raise taxes, where we'll see who they raise taxes on. Anytime they say that they want to raise taxes on the rich, they usually ends up trickling down to the poor and the middle class who end up bearing the burden of that. Or if they're not able to raise taxes, or if they're not able to raise enough taxes, well, they're not going to slow down their spending. What they will do, they'll print this money, they'll create this money, and then they'll use this newly printed money to pay for your costs. So now, no problem. Your costs are covered, but this money had to, again, come from somewhere. If this money is printed to cover your costs, then who pays for it? Again, it's the average person. So now you're paying for the cost twice. You have to pay for the cost with your higher taxes, and then you're paying for the cost through your higher inflation because now the price of everything has gone up. So the idea and hope that she's going for is that by increasing the government spending now, they will be able to lower the cost for you, which if that works, great, we're able to lower inflation. But if it doesn't work, either because it costs more than what the government expected, or because it's too inefficient, or because they're not able to raise enough taxes to do that, well then now the cost is again paid for by you through higher inflation. And this, my friends, is why it pays to be financially educated. Literally, because the person who always ends up paying the price is the person who is not financially educated, the average person. And who keeps getting richer no matter what happens is the person who's financially educated. So what I want you to do is to stop getting screwed over by the system and get financially educated. That way you can take care of yourself, that way you can take care of your family, and that way you can take care of your community. If you like what you saw so far, then you're gonna love this. CNBC just put out an article titled "Rent Prices Are About to Go Up Again." To put the rent increase in perspective, back in 2017, 2018, and 2019, rent prices were going up. In the first half of each of these years, the average rental price in the United States grew by right around 3.3%. But now if we fast forward a little bit to 2021, during the first 6 months of 2021, rental prices, the median rental price in the United States grew, not by 3.3%, but by 11.4%, and it doesn't look like this number is going to be slowing down anytime soon. That means if you rent your home or if you rent your apartment right now, it is going to be more expensive for you to rent your home or rent your apartment because of the housing market and because of the inflation that we're seeing right now. The article says rent is surging for a number of reasons, including more certainty in the job market and young people finally moving out of their parents' basements. These rising rents mean that you're going to have a big chunk of America that are now going to be spending more than 30% of their income just on their rent, which is going to make it harder for them to have money to spend other places. Renting your home isn't always a bad thing. I mean, it's better for some people to rent a home than to own a home, and just because you're renting a home doesn't mean that you can't afford to own a home. You have a lot of quote unquote experts out there talking about how owning your home is the way to build wealth because now your rent is not just paying off somebody else's mortgage, you are using your monthly payment to build equity in this home. But how many rich people have you heard talking about how they got rich by buying their home? The home that you're living in can make you money if you sell it for more than what you bought it for. But the problem with that is now you have to sell your home and you have to move somewhere else. And a lot of times people start to make their home buying decisions based off of what it would be if it was an investment instead of really understanding what their home really is. If you can comfortably afford a $400,000 home, you can afford a 20% down payment, you can afford the monthly payments, and it's not really going to put a lot of pressure on your finances. But then me, as the banker or the realtor, I tell you that your home is an investment. So you really want to think carefully about what kind of home you want. Now you might second guess yourself. Maybe you'll say, maybe instead of putting 20% down, I should try to only put down 5%. Now you can buy a much bigger home and you're gonna stretch your monthly payments. Sure, you can still make the payments. This is gonna stretch you a little bit more And now instead of you putting more money aside towards your investments to buy rental properties that are going to pay you with cash, or instead of investing money into the stock market or to other assets that will actually pay you for owning them, now you're just hoping that your home is going to grow in value, that when it comes time for you to sell, you're going to have more equity in your home. There's nothing wrong with owning your home as long as you own a home that you can afford, and there's nothing wrong with renting a home as long as you're investing the rest of your money. The mistake that so many young people make is that they'd rather buy a home than they would a rental property. If you want to really become wealthy and you want to use your money as a tool to become wealthy, go out and buy a rental property before you buy your first home. Now that I'm done with that rant, this brings me to the issue that we're facing right now, where rental prices are surging. If your lease expired in 2020 and you went out to go find a new home, or you renewed your lease, chances are you might have been able to get a free month of rent, or maybe you were able to get a huge discount on your rent. There was a lot of people that were out searching for homes and they were able to get 30-40% discounts on their rents because 2020 was a crazy year and nobody knew what was going to happen in the economy or the housing market, and so landlords were handing out discounts on rent. See, back in 2020 you had a lot of supply of rental properties but not enough demand, because back then a lot of people stopped making money, and so landlords were doing anything to get somebody who had a paycheck willing to pay them rent. Now the dynamic has shifted. Our economy has improved a lot since 2020. It's not back to where we were back in 2019, but it's improved a lot. But the bigger issue is right now you have a lot of people looking for homes, whether it's to buy or to lease, and you don't have that much inventory available out there. Even if you go out to look for a home to lease, there's not that much inventory out there. It's the same issue you see in the housing market when people try to buy a home. If you're listing a home for sale for $300,000 and then all of a sudden you list your home and 2 days later you get 45 offers, well then you're gonna say, hey, we have multiple offers. Please submit your highest and best bid by Monday and then we'll pick the best offer. And then people are gonna say, oh, I really wanna get this home. Maybe instead of offering $290,000, I should offer $310,000. And somebody else offers $330,000. That's how you start boosting home prices, because now you have more demand than there is supply. So now the buyers are fighting against each other with higher prices, which pushes home prices up. You're seeing the exact same thing in the rental market, where you don't have that many homes available for lease, and so renters are having to fight against each other by paying more money for the leases in order to get into a home or an apartment. Part of the reason for that is people wanted a change of home. Now because of this pandemic, people have the ability to work from home, and so people started buying homes with a yard and with an office, but it's the same with tenants. You have tenants that are now wanting more space because now they can work from home, so they moved out of cities and moving into the suburbs. They want a yard, they want some more space, and so people have been shifting into these homes, which means you've had a lot of tenants looking for these properties with not that much inventory, which has pushed rental prices up. And you also had a lot of young people, when the pandemic hit, move into their parents' homes, so the requirement for inventory really decreased, and now it's increasing because people are getting their jobs back, they're starting to get an income again, they're starting to feel more confident about the economy and the world, so now they're moving out and they need a place to stay, so you have more demand out there looking for these properties. Going back to the article, Nicole Bashoud, who is a market analyst at Zillow, predicts that some of the most affordable places in the country, especially in the Southwest and the Sun Belt, including Austin, Texas, Las Vegas, and Phoenix, will become some of the least affordable by the end of the year given the demand. And what's more, quote, we don't really see rents dropping again in the near future. You might think, hey, if rental prices are going up so much, then people should just go out and buy homes, which would make sense. Except home prices have also skyrocketed. And so these higher home prices actually support higher rental prices, because if people could save a lot of money by renting their home than by owning a home, then you'd see more people going to renting. Likewise, if it was way cheaper for you to own a home than rent a home, then people would stop renting and go to ownership. What this means is the cost of living is going up. Doesn't matter if you're buying a home or if you're renting a home. It is more expensive to live somewhere in the United States than ever before, and this trend doesn't look like it's slowing down anytime in the near future, at least. The tricky thing though is, how sustainable is this? Because wages have not been keeping up with the rising cost of living. The fact that we're seeing 10% growth in housing prices in less than a year while wages are nowhere near that tells us that, hey, housing costs are growing like this while wages are only growing like this. So eventually you're gonna hit a point where people just can't afford to rent a home, or they can't afford to own a home, which means that people are gonna have to downsize, which is not so good news for the economy, which is something that could create a very weird dynamic in our economy if something doesn't change. I will talk more about this, but the thing that you have to understand right now is the person that's benefiting from this, again, is the people who are financially educated. It is the asset owners, the investors, the people that own the rental properties, because now when rental prices go up, well, that benefits you because now you make more money in rent. This is again why financial education is so important. That way you know how to use your money as a tool. That way you can benefit from the way the system works instead of being the person that's just paying the price. Now, if you don't have the ability to go out and actually buy a rental property right now, then the next best thing is to do something like crowdfunded real estate. Because the way crowdfunded real estate works is you invest your money into a fund, and then this fund gives you exposure to a portfolio of real estate, and then when these properties generate rent or they appreciate, you get your share of the profits. The nice thing about crowdfunded real estate is now you don't gotta worry about dealing with tenants, you don't gotta actually find the property yourself, and you don't gotta worry about the day-to-day headache, and in exchange, you're still getting exposure to real estate. The only way rents are gonna start going back down is if we see a shift in our housing market, because right now we have more demand than supply. When you have more demand than supply, you have more buyers, more renters, than you have inventory, which means that now the buyers, the renters are having to fight against each other to lease a home. But if this switches, where you have a lot of homes listed for sale or listed for lease, and then you don't have that many buyers or tenants out there, well then now the landlords, the property owners are gonna have to fight against each other to get a tenant, which means now they're gonna have to cut their rents to make the property more attractive for a potential tenant. The way that you can see that happen is one, if we see a whole new inventory of homes created. Maybe that means we're gonna build a whole lot more homes, or we're gonna build more apartment complexes, or maybe that means that you're gonna see a lot more investors start buying up properties, and now you have a whole lot more homes listed for rent. But in order for that to happen, you'd probably see home prices jump up even more, because now you have all these investors trying to buy homes. The second thing that could potentially cause a rental price correction is if now rental prices are so high to the point where people can't afford rental prices anymore. This is kind of the same issue that we've been seeing all around us, where if you go to the grocery store right now, you're going to see the grocery prices are way higher. If you go and buy a car right now, you're going to see the car prices way higher. If you go and you try to buy a vacation, you're going to see that flight costs are way higher. So right now the price of everything is way higher, partially because people have the ability to pay it. But eventually we're going to hit the point where people can't. People won't be able to pay rent, people won't be able to buy all these things, and when that happens, something is going to have to correct, because if businesses are not able to sell their stuff, if landlords are not able to lease out their properties because it's too expensive, then they're going to have no choice but to cut the rental prices, because otherwise your properties are going to be sitting there vacant and businesses' inventory are going to be sitting there idle with nobody buying it. And this is the thing that a lot of people are worried about, especially now as we're starting to see the government money start to fade away. We're starting to see the unemployment programs starting to fade away. We're starting to see the free government money starting to fade away. So now as this is happening, what's going to happen? Are people going to be able to support themselves on their own two legs? Are we going to see people go back to work to get an income to be able to support this? And are the wages going to be able to support the higher costs, or are they not? This is something that every economist is glued to the edge of their seat to see what's going to happen, because if now people are going back to work and they're not able to make enough money to pay their bills, they're not making enough money to pay their rent, then this could create a real shakeup in the housing market. Because now if you have people buying properties highly leveraged, assuming that they're going to get these rental prices that they're getting right now, and then they're forced to cut rental prices, well then that could create a problem. Because now they might not be able to pay their mortgage payment. They might not be able to pay all their fees because they're not making enough money to pay all their fees, because they expected to make this much money, but they're only making this much money. So this is the thing that a lot of people are really worried about. Because if people are not making enough money to pay their bills, to pay their rent, and to live their lives, well then that creates a whole sort of economic disaster. Until then, rent prices are probably going to keep going up. They might not go up at the speed that we saw in 2021, but they'll keep going up until we see something change. If people go back to work and they're making more money and wages go up, well then that means rental prices will continue going up, because now wages are going up too. Sure, they might not be keeping up with rental prices, but if wages keep going up and people still have the ability to go out and spend, and they have the ability to pay for their rent, then that means that rental prices will probably keep going up too. The key for what's right for you, whether it's renting or buying an investment property, depends on your financial situation. If you can afford to buy a home and you want to buy a home, then go out and buy a home. If you cannot afford to buy a home, or if you don't want to buy a home, then rent a home. You just got to understand how the system works and make sure that your rent fits within your financial system and you're not stretching yourself too thin because of your rent. But it doesn't really work like that. There's a lot more to becoming wealthy than just having a big salary. I mean, it can help, but if you don't know how to use your money, or if you don't have the right mindset, or if you don't know how to pay yourself, or if you don't have the right patience, then it doesn't really mean anything. It's all about what's in here before you make the money. If you actually want to become wealthy, there are 5 things you need to do.